In this video, we are going to talk about financial statement forecasting. We are going to cover some basic explanations of what it is, and then we'll have a different video with some Excel sheet examples on the actual calculations and the practice. The percent of sales method is a commonly used a way to forecast the financial statements. Generally speaking, is you forecast sales, and then everything else will have some kind of ratio or percentage related to it. Some items are not going to be directly related to sales, but we will discuss them as we go through this financial statement forecasting. So as you see on the slide, the simplest technique for forecasting the income statement and balance sheet is the percent of sales method. The basic idea: many items of statements tend to rise and fall at approximately the same rate as sales. Unless you fall outside the standard parameters, the company is already set up to operate in a certain way to support the sales and to be more efficient in that way. So it's safe to assume that it will continue that pattern. So if sales are expected to increase 10%, then it probably makes sense to guess that cost of goods sold will also rise by 10%, but not per unit, the total. If you say it per unit, then you're saying it's becoming more expensive to produce it. No, you're saying your total cost of goods sold will go up by 10% because you're selling 10% more. So you have to produce more. The most important input in sales forecast, as this derives the forecast of for the other items, cost of goods sold and the relationship with sales. Now, for this portion, we are not going to talk about how to forecast sales. We're just going to give you the sales forecast, and we're going to talk about everything else in the financial statements that will be forecasted according to that. In a different chapter, in a different video, we'll talk about forecasting sales specifically. Here's a quick example of what it's going to look like. The actual process, we'll discuss it in an Excel sheet, a different video. What you're seeing here is the previous 2 years, 2019 and 2020, and 2021 is going to be the year being forecasted. The example that they talk about here, even though it applies to most of these things, is that they took the cost of goods sold, they took the average of the last 2 years, and the average was 83.93%. So it doesn't mean that each year was exactly 83.93. They took the average and assumed that the average will hold true for the year being forecasted. So the sales forecast in this case was given was 4,300,000. And so the cost of goods sold averaged at 83.93%. Then this number, the 3,609,000, represents that 83.93%. And then of course, gross profit is just this minus this. So not every line is going to be forecasted with previous year's averages. Some of them you just add and subtract. They also have the SG&A. Here is done through the average of 8.58% of sales, and so on. And you can continue doing them as is. Now, fixed expenses, since we are saying that we're within the same parameter, we didn't have to add another machine, a piece of machinery, or add another building or another factory. So we can assume that fixed expenses stay the same. And I used fixed costs, fixed expenses in the sense of machinery, but it doesn't have to be that. It's anything that is fixed. Now, not all items need to be a result of change in sales. Depreciation, for example, it's always related to change in depreciable items, not sales. So if you're in a scenario that your sales went up, but you didn't buy or sell any buildings, for example, then your depreciation wouldn't change even if your sales went up. Now, in this example, they talk about that there was some increases And fixed assets, they give you that piece of information, but it's not due to changes in sales. It was just a different a decision based on different considerations, but it doesn't have to change, and that's the point. Items like depreciation do not change because of sales; it changes because of fixed assets. And there's the income statement. Now we move on to the balance sheet. The balance sheet is a little has a little more complexity to it. However, you start with the income statement, you end with the net income, you can move on to retained earnings. Now, with the balance sheet, some things will be related to changes in sales and some things may not. And we'll discuss them as we work on the Excel example. But it's important to understand that. And then what happens that even after you properly forecast the assets in order to start working on the balance sheet, you allocate to retain earnings and liabilities accordingly, you're still going to have some unbalance, and this is normal. This is normal. There's still going to be some imbalance on the balance sheet. Now, what you do is at that point, that's when companies decide, okay, do we borrow more money? Do we issue bonds? Do we sell some stock? Or it could be the other way around. Do we pay off debt? Do we buy back some stock? So that's financing decisions that happen after we work on the balance sheet. Because as your sales increase, you may have to adjust your liabilities and equity accordingly. This could also be true if sales go down. We're just going to assume that the regular cycle, your sales grow. So discretionary financing needed. This is the what you work with once you're done with the forecasting part of the assets that deal with the changes in sales. And then you're going to have some financing needed. So if you are short, then you make a decision of, okay, let's sell some more shares or issue more bonds or borrow more money, commercial loans, for example, long-term debt, in order to make the balance sheet balance. And these is not just something you do, well, we got to make the balance sheet balance. It's typically is additional funds needed for the company to continue operating into the future, because you have to prepare for future sales. A business prepares first, sales next. And this is kind of the way it's done to maintain a healthy level of cash, a healthy level of inventory, and a good balance in the capital structure. Also understand that, as I mentioned, we typically say that you're going to need, as you grow, you're going to need more financing, but sometimes you may have excess cash, or it could be another way. Excess cash is just an example. And then you have to do the opposite. Instead of borrowing more money and selling more stock, you can pay off debt or buy back stocks and whatever the decisions made by the board and the executives. Other forecasting methods is the linear trend. So you can do a trend analysis. Now, Excel has a few tools, a few different ways to do this, and we'll show them. But you can just do a trend within the sheet itself and get out the next number. Instead of doing the percentage, it just follows the trend. That trend in Excel happens to follow the basics of regression, but also be aware that there's an actual regression tool in Excel. We will demonstrate both so you can see how you end up with the same number. However, when you use the regression tool, you get a lot more information, levels of significance, standard deviations, variance, and other items like that. We won't stop this part of the lecture here. And on the companion video will be the Excel sheets working on these numbers and the things we just talked about.